Welcome back, everybody. So for some reason, option trading in general seems to have a very negative connotation associated with it. I've spoken to hundreds of investors over the years, and if I mention that I invest in stocks or bonds or gold for that matter, people will say, yeah, me too, right? It's no big deal. If I say I've developed some ETF rotation strategies, they'll say, that's interesting. I can even mention that I invest in the various volatility products. They'll say, oh yeah, I've heard of that. What is that? But inevitably, if I say, yeah, and I also trade options, they'll say, oh, that's risky. No, that's too dangerous. I have a friend who lost all their money doing that. And this used to surprise me because the truth is, option trading is an excellent risk management tool, and it offers a near infinite number of ways to structure trades using math-based systems, rather than just relying on our own market predictions. Having said that, though, in fairness to the people that do give this knee-jerk type of reaction, the reality is that most option traders do lose money in the long run. Perhaps if more people were successful with it, the perception would change. So in this video, I want to go over three common mistakes that new option traders make. Now, I could probably make a list of 10 or more, so this will likely be a running series, but today I'm going to go over three of them. So rookie mistake number one, trading price rather than volatility. So often I hear traders talking about their strategies, and it usually boils down to some type of market prediction. Maybe they think the next iPhone is going to be a slam dunk, so they buy call options in Apple. Or they think the markets are overpriced and just about to collapse, so they may buy a put spread on the S&P 500. So while it's technically true that they are trading options, essentially what they're really doing is just making market price predictions and then using option contracts as the underlying trade vehicle. But in my opinion, option trading involves harvesting the volatility risk premium, which is the difference between implied and historical volatility, or profiting from the composition of the option Greeks, maybe capitalizing on Vega crush, or trying to capture some daily theta decay, maybe gamma scalping, or delta hedging. These are all examples, in my opinion, of option trading in the true sense of it. But buying call options on Apple because you think the stock's going to go up, why not just buy the stock? Or buying a put spread on the S&P 500 because you think a collapse is imminent, why not just buy an inverse S&P 500 ETF? And if it is the leverage, if that's what you're after, then there's plenty of double or triple leverage products out there. You certainly don't need to use options to make price predictions. I don't believe anybody can consistently make market predictions with any accuracy. If I started basing my option trades on my own gut instincts and my own market predictions, I would imagine my success rate would very quickly move towards 50-50 because that's just not a winning strategy in the long run. So in general, I think option traders out there would be a lot more successful in the long run if they shifted their focus towards the math and the underlying fundamentals of the option market, rather than just making market price predictions. So rookie option trader mistake number two, not respecting the impact of trade fees. You can go into investing chat forums or financial blogs with people talking about their option trading strategies, and you may hear something that sounds like, for example, okay, I'll start with an iron condor, and if the markets move against me, I'll maybe sell the vertical call side and roll the put side down a few strikes. And if the markets continue to move against me, maybe I'll roll the puts out to the next monthly option expiration. And if the markets go against me again, I'll just roll the whole thing into an iron butterfly. Now, options lingo aside, the point is, it's just a constant churning of fees. Every new trade costs more money, and not a small amount either. With option trading, you not only pay to open the trade itself, but you also pay for each option. And oftentimes these are spreads with multiple legs, so you can sometimes double or even quadruple the fees. It really starts to add up quick. For the average investor out there, and professional fund managers for that matter, they really only make about a 5% annual rate of return in the long run. So churning expensive option trades can easily eat away at most, if not all, of that potential profit, which is a huge disadvantage right from the start. That would be like tying your shoelaces together in a marathon before the gun even goes off. In my opinion, beginner option traders get so excited about all the possibilities, their mind goes in a million different directions, and they forget to just keep things simple and keep those trade fees reasonable. Option trading mistake number three is using one strategy for all market environments. Option trading is tough, and it can take a while to learn all the intricacies of a specific strategy. You have to learn about the risk-reward profile, the impact of margin, how it's going to behave in different market environments. There's a lot to learn. So sometimes when new option traders They put the work in and they get to the point where they're feeling pretty comfortable with a strategy, they start trying to apply it to everything. Individual stocks, indexes, low volatility, high volatility, everything starts to look like the ideal target. And I'm sure you've heard the old saying, when all you have is a hammer, everything starts to look like a nail. If your hammer in this case is a general understanding of iron condors, for example, then it's really tempting to just start slapping on iron condors in every market environment, every month, in every situation. But to be successful in the long run, we need a whole toolbox, not just a hammer. Every option spread out there has advantages and disadvantages. For example, you can buy calendars or butterflies in low volatility environments, but it's not a good idea to buy them when volatility is high. Selling straddles and strangles, that's a fine strategy, but not when there's binary events on the horizon like major Fed meetings or maybe key earnings announcements. And what about iron condors? Arguably the best and most universally used option spread out there. Do they always work? Here's some monthly results for my iron condor strategy. Now I can tell you that I definitely try to get a trade once or twice a month. But on the other hand, I don't just go trying to jam a square peg into a round hole just to get a trade done. If conditions aren't ideal, cash is the better position. And you can see here that there's plenty of months with 0% return, which means I wasn't able to find a suitable trade. Most of the time because volatility was too low. Iron condors are awesome, definitely my favorite, but they perform better in higher volatility environments because they are a short vega trade. So for 20 months out of 66, which is 30% of the time, I was in cash because my strategy doesn't apply to all market environments. No option strategy does. And this is a mistake a lot of newer option traders make, trying to use one type of spread for all market environments. So hopefully this video can help a few newer option traders out there settle into some better long-term habits. If used responsibly, I don't think option trading is inherently dangerous at all. And in fact, it could be considered safer because you can build the risk management right into the strategy. But there are some common mistakes and a few pitfalls here and there that newer option traders fall into, so keep these tips in mind. Trade the math rather than your personal market predictions. Always try to keep those trade fees as low as possible, and learn multiple strategies so you always have the right tool for the job. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all 3 of my trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you, so go ahead and leave those in the comments section. See you next time.